Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Today in studio is Chris Hyman, and he's got a special guest, and that is Edward Gordon. Chris, why'd you bring Ed on the show today?
Yes, well, thank you, Eric. Happy to be back on here. We brought Ed on today to discuss really a specialized tax-efficient planning tool that's utilized by the ultra-affluent marketplace. It's called Private Placement Life Insurance, or PPLI for short. Ed is very well versed in this space, and we're really excited to have him on the podcast, and I'm looking forward to getting his insights on this subject. So, Ed, welcome to the show.
Thanks for having me.
I guess let's start by, can you tell the audience a little bit about your background? Maybe touch on, I should mention, if I didn't, Ed is the president and founder of Preservation Capital Partners. Maybe touch on who Preservation serves and the services you provide, and then we can dive into the private placement space.
Sure. In 2005, I created Preservation Capital Partners, and really what we do is what the name of the company is. We preserve capital. We're not in the business of investing people's money. We're not in the business of trying to beat the market. Most of our clients are extraordinarily wealthy people, family offices, big corporations, and they're more worried about the preservation of their assets so they're not subject to the loss of taxation, inflation, or creditors. So we act as a utility player in the planning process and bring ideas and products to the table that achieve that goal. Over the last 30 years, I started out in the life insurance space, and that led me down the road of really doing a lot of different projects for people, most of them all tax related. So we're always looking to create the most efficient transaction in whatever a client's doing from a tax perspective, asset protection perspective, and an estate planning perspective.
Well, getting right to it, in a nutshell, what is private placement life insurance? And in particular, what sets it apart from the more traditional life insurance?
It's a good question. So in a normal situation, life insurance policies in general enjoy certain special tax benefits. When somebody puts an outlay or premium into an insurance policy, a permanent policy, some of that money goes towards commissions, overhead, expenses of the insurance company, and the cost of the death benefit itself. All of the excess money ends up in a bucket that we generally call cash value. So to say it a different way, the cash value of an insurance policy is an overpayment of the cost structure. And the government says that accumulation of that excess cost grows inside of the insurance policy entirely free of taxation. If the policy is created in we'll call it a normal way, money can be borrowed out of the insurance policy entirely tax-free. And when the insured dies, all of the assets of the policy are paid as a death benefit tax-free to the beneficiary. The problem with the retail world is it's quite expensive. There's a building in New York City, I won't tell you what insurance company, but they have a 22-karat gold roof on their building, and you don't, for a reason. The insurance companies know how to make this a very profitable business for them. In a traditional universal life policy or a whole life policy, the insurance company invests that excess cash value in the insurance company's general account. And if the insurance company went out of business, your cash value is subject to their creditors. The insurance company's ratings are very important because you want to make sure that you're putting money into a high quality insurance company. The drawback to that is that the cash value is invested in their general account, not only subject to their creditors, but the insurance company also isn't taking very much risk with those investments. In order to keep their ratings high, they're going to invest into mortgages, fixed income, pretty safe investments. There's another product that they have called variable life. And in a variable life policy, the cash value isn't invested in the general account of the insurance company. It's actually invested in a segregated account and uniquely not subject to the creditors of the insurance company. So if XYZ insurance company went out of business, your cash value is protected because it's a segregated account of the insurance company. In those products, the insurance company typically allows you, the owner of the policy, to invest in a selection of mutual funds or other types of investments that are on the insurance company's platform. If you were New York Life owns a mutual fund company called Mainstay, so maybe there's a whole bunch of Mainstay funds in there. Pac Life owns another group of insurance around the mutual fund companies, so you'll see a lot of that on there. And they might throw in some other stuff like other funds like a Blackstone real estate fund. So it kind of looks like a client's 401k account, where you get to select which of the fund managers you want along that profile. Obviously, the reason why you would do that is because all of this money is being invested. It's being invested in a tax-favored environment. And when a typical scenario, if somebody doesn't pass away and it's not paid as a death benefit and they reach maybe retirement, maybe they start drawing loans out of the policy to supplement their retirement. And obviously, investing in the markets or mutual funds affiliated with the market, you are expecting to get a better rate of return than if you invested in a policy that invested in the general account of the insurance company that's in bonds, mortgages, fixed income, and so on. So That's really the basis for what private placement is, because private placement life insurance is really nothing more than the institutional cousin of variable life. You need to be a qualified investor to be able to buy them. One of the things that we always say is wealthy people can do things that other people can't, and this is one of them. Because you have to have certain
real quick, how you put that? I think PPLI. So basically, you're saying it's more like a variable contract, variable universal life contract. With all the normal tax advantages, the tax deferred accumulation, step up in basis of death. There's no taxation on movement between the assets within the contract. You get tax redistributions if structured properly, as you alluded to, with loans or withdrawals at the cost basis. But with maybe the added advantage here of they can invest in alternative asset classes. Is that
right? So as we say, there's a couple of flavors of private placement variable life. The one that's most commonly known, sometimes we call the pedestrian version, is really variable life light, meaning that the cost structure is significantly less than the retail product, and the investments that are on the insurance company's platform are sexier investments because the people that are allowed to purchase them are allowed to purchase hedge funds and other types of assets that the non-qualified investor normally can't get into. So being a qualified investor, you can access hedge funds and all sorts of other sexier investments rather than the insurance company's mutual funds. So it's a skinnier product with sexier investments.
Okay. You started mentioning accredited investor and qualified purchaser. Can you go into a little more detail on that? Who's ideal candidate for this style of coverage?
Somebody who has a net worth in excess of $5 million. Somebody who understands riskier investment classes. Someone who has experience. Again, you're not investing in mutual funds. You're investing in hedge funds that could lose 30-40% in a year. You're investing in, you need to be more market savvy to understand the underlying investments that are in these policies.
What are you seeing as some of the most common reasons that clients are investing in PPLI in terms of purpose of coverage? I mean, is this a pretty even mix between maybe generational wealth transfer or just pure cash plays, or what's the typical purpose of coverage, or is this just all across the board?
Well, so you could achieve the same tax-free investing structure through a Roth IRA. So if I was able to create a Roth by either creating one or converting an IRA to a Roth, I can invest in the same type of asset structure through my Roth and have tax-free growth and withdraw the money tax-free at retirement. One, not everybody can create a Roth. Not everybody is willing to bite the tax bullet to convert to a Roth. So the insurance policy becomes a very easy way with an unlimited amount that you could put in basically and have your money grow tax-free. That's one profile. So that's just the individual investor who wants to invest their money in a more tax-favored environment. But typically, our clients, because they have substantial wealth and they're subject to estate taxes, we would want to have these policies owned, like a lot of life insurance policies, in an insurance trust. So not only does the money grow entirely tax-free, not only does the death benefit get paid out tax-free at death, but it's also not accumulating in the taxable estate of the grantor. So we have the majority of insurance contracts that we have that are private placement are typically owned by a family entity or a family trust that's outside the taxable estate. So you're really hitting on a lot of prongs, as I described. Money grows tax-free. Money can be borrowed out tax-free. And at the death of the insured, all the assets go tax-free to the beneficiary, and it's outside the taxable estate. There's really no other way of achieving a quote-unquote step-up in basis on investment assets that are held by a family trust. If the grantor of a family trust passes away, the assets in that trust don't get a step-up in basis because the grantor didn't own those assets at the time of their death. Because it's a death benefit, and death benefits are paid tax-free, it acts as if it was a step-up in basis.
Based on the tax advantages that are involved, how would you say that this is currently trending? I mean, we have kind of a black cloud hovering of tax legislation that's looming on the horizon. Many believe taxes are set to increase all over. Do you see an uptick in PPLI investment or exposure due to these looming tax hikes?
Yeah, I mean, we've never been busier. Starting after the election last year when Biden got elected, and then certainly after the Senate fell to the Georgia Democrats, and our phone was ringing. A lot of the lawyers at the head of tax departments were referring their clients to us to, in essence, wrap the client's assets. Wrapping meaning, it was an old Wall Street term for using an insurance wrapper to wrap around your assets to protect them from taxation. So we became very busy, and we were probably doing 4 times the amount of business a month than we had been doing in 2020 and 2019.
Wow.
And part of the reason is that I think clients are starting to realize that every couple of years, the whims of Congress keep on changing how they structure things. And as one client said to me, I keep on creating these plans that will last for all of perpetuity. And I realize that as the winds of Congress change, those plans that I put in place may not remain stable. But by utilizing these policies to hold portfolios of investments, and it kind of eliminates the legislative risk on taxation of investments. There may be, another Trump may come into office, and this may look like wasn't the greatest deal in the world, and 4 years later, somebody like a Bernie Sanders may get into office, and this could look like the smartest move anybody ever made.
Yeah. So just drawing off that, what kind of flexibility is embedded into these structures once you set a private placement life insurance contract in place? And I'm sure this goes into ownership structure, but going with what you just said on terms of obviously the estate tax landscape changes over time. Are we able to structure these in ways that the clients can pivot?
I mean, that's a lot of it has to do with the abilities of the lawyer to draft trust documents, to have the flexibility so that the assets are held outside of the estate, but maybe you could have a spousal trust so that your spouse could be a beneficiary of the trust or a discretionary beneficiary of the trust. So if in case the client and their spouse needed assets, the trustee could borrow money from the insurance policy and then distribute it out to the beneficiary. like any other trust that's held outside the estate, this is nothing more than, the way I view it, nothing more than an insulating layer that wraps around the assets inside of a trust. So whatever the language of the trust and the flexibility that was built in will dictate those terms.
Okay. Who are some of the main carriers offering PPLI? Is it mostly known names in this space?
When you say in my world, we know all the names, but they may not be commonplace. Although companies like Prudential and Nationwide and Zurich and Pac Life, New York Life, Mass Mutual all have some variation of private placement life insurance. Some of it is only institutional, some of it is only for banks or big corporations to buy. Those are much larger cases, and some of them found their way down to the called the individual high net worth marketplace. There are other companies that many people haven't heard of. There was a company called AGL Life or Philadelphia Financial that was eventually bought by Blackstone. Blackstone acquired a company in Europe called Lombard International. They have companies all over the world. And Lombard International is a private placement life insurance company.
What about, can you briefly touch on because there's a kind of what's called onshore versus offshore in the space, or domestic versus international. How does that work? Can you briefly describe, because there's a lot of times, or sometimes at least to my knowledge, when people are going into this sort of contract, they might use an carrier that's domiciled not in the United States. Why would they do that? And what are some of the advantages and disadvantages versus using a domestic carrier?
Flexibility and cost. In most of these private placement life policies, the amount of death benefit that's needed is supplied 100% by a reinsurer like Swiss Re or Munich Re or Berkshire, Canada Life. These are wholesalers of risk to companies like New York Life and so on. So if I was a private placement life company and maybe I don't want to absorb any of the risk of the client dying, I would just go out to one of the reinsurance companies and have a treaty with them, and they would in essence insure the client for the death benefit piece. I'd set up an LLC that would be the cash value. I'd have a list of hedge funds and so on that could be on that platform that the owner of the policy can choose from. And the insurance company itself that I run really is nothing more than an administrator that has a license to create contracts of life insurance in a state or a foreign jurisdiction. So the insurance company is really irrelevant in the sense that as long as their fee structure that they're charging to do this is reasonable and they're good at what they do, we don't care about their ratings, because under the separate account rules, if Bob's insurance company went out of business, we would just replace Bob's insurance company. His creditors can't touch that cash value. So from the standpoint of domestic or foreign, the company is really irrelevant. In a domestic company may have to put up money in reserves for every contract they write, even though they may not hold any risk. Whereas maybe if they did it in Bermuda or Mauritius or Cayman or Barbados, they don't have to put up any money per policy, which makes it more efficient to run the insurance company. So the products tend to be a little bit cheaper. There are territories that allow for death benefit to be paid in kind. So if your insurance policy had $5 million of death benefit attached to a bucket of $50 million of assets, when the insured dies, $55 million is paid, $5 million, let's say, from Swiss Re Insurance or Munich Re, and the insurance company pays out the cash value. And if you're in a jurisdiction where they can pay out in kind, they don't have to liquidate those assets. They'll just turn over those assets to the beneficiary as the death benefit, tax-free, at then market value. That is easier to do in a non-U.S. company. But I need to clarify something. For U.S. people buying non-U.S. insurance product, they'd want to look to a company that's called a 953D elected company. A 953D elected company means that the insurance company has elected to be treated as a U.S. company for all taxation purposes. So in essence, it's a U.S. company, but they just happen to be located outside the United States. And if they're in a territory like Bermuda or Barbados or Turks or Mauritius or Cayman, those territories have a treaty with the United States that says if you have a life insurance policy and it meets the definition of insurance under Section 817H of the tax code and 7702 of the tax code, the United States will recognize that for all tax purposes as a life insurance contract. So here, where some people think that the term offshore is somehow nefarious, it's absolutely not. Nobody's hiding any money. Everything's reported. The owner of the policy actually should fill out a foreign account reporting form every year that says that they have an interest above $10,000 in a foreign account, even though the money may be held here at Fidelity. The fact that you own an insurance policy that's held offshore, we think that everybody should fill this out. So nobody's hiding any money. These insurance companies aren't doing anything nefarious. Everything is fully transparent, and you get a little bit cheaper of a product and a little bit more flexibility.
Excellent.
There are other reasons why somebody would use a foreign insurance company. For instance, if you're a non-U.S. taxpayer and you were utilizing this product and maybe it was the country that you live in recognizes a different type of insurance structure, you may choose to use an insurance policy that's a non-953D elected carrier.
Yeah, so there's definitely some planning that's involved there. But it seems to me as long as you're going 953D, and in terms of offshore onshore, you can get some advantages there with pricing and with flexibility.
There's an additional drag. Additional drag is these policies are not, if it's a non-U.S. carrier, even though it's a 953D, since insurance companies are admitted per state, not federally, to be licensed, and these companies are not licensed in any state, the client may need to go outside the United States to take an exam. The owner of the policy, the trustee, may need to be solicited and delivered the policy not within the United States. You can't get cute and say that you're going to go to the British Virgin Isles Embassy in Manhattan. I just think that's too cute. I think people tried that years ago. So we have clients that jump on a plane and go to Bermuda or Canada to take a physical, and the owner of the policy is a trustee that's either non-U.S. or signs paperwork outside the United States.
Okay. Interesting. So maybe planning it to coincide with a nice little vacation.
Yeah.
So pivoting to policy mechanics, what kind of costs are associated with private placement life insurance? Really the performance drag. What kind of cost buckets, for lack of a better term, are we seeing here?
So you have two different cost structures in the contract. You have the cost of the insurance structure itself, and then you have the cost of the investments. So if I had $1 million of cash value in my insurance policy and I invested in a mutual fund or a hedge fund, that hedge fund may still be charging 2 and 20 or whatever their fee structure is on that account. So that is not really an expense of the policy per se, although it is. It's really an expense affiliated with the investment choice. The insurance policy itself has a fee structure. There's the cost of insurance, the actual term insurance piece that's bolted onto that investment bucket. That has a cost every year. And the insurance company charges a fee for managing this whole process. Those fees together will run in and around 100 basis points a year, depending on the carrier. The investment is standalone. So if for some reason you put all your money into a series of ETFs that are available on the insurance company's platform, that would obviously be the lowest cost for the investment piece, but the insurance product itself still will cost anywhere around 1% of asset value a year.
That seems like a valuable trade-off if we're looking at some of these alternative asset classes that are highly tax inefficient. We're looking at just 100 basis points or 1% drag on average seems like a valuable trade-off to me.
Well, when you think about it, if I earned 12% on my money in a fund that was all short-term gain, and I lived in California, I would walk home with half of that. Actually less. If I made 12%, maybe the fund keeps 2 points for themselves and I get 10, but I pay tax on 12. So now I have, on an investment that I made 12%, I actually walk home with 4.5% of my money net. If it was purchased inside of an insurance contract, maybe you lose the 2% that you paid them in a fee. You paid the 1% to the insurance company. So your 12% just became 9. Well, 9 is definitely better than 4. So we always tell people if the cost of the insurance is less than the taxes that you would have been paying, you got a great deal. Will that happen every single year? No. Years that you didn't make profits, years that didn't generate what would have been taxable, you're going to pay a fee for because there's a cost of the insurance. But over any length of time, it should be a home run.
What about we had touched on minimum the kind of net worth to go into this contract. What about minimum premium? Is there a kind of minimum threshold of dollar amount that needs to be paid into a private placement life insurance contract? And what would that amount be?
So it really depends on the flexibility of the insurance company and what you perceive to be your rate of return. So if I put $5 million into an insurance policy, I think that becomes really efficient. At $2 million, I think it's very efficient. I think when you start going less than $2 million going to the policy, although the insurance companies typically have fees that are a percentage of the asset value, there are some fees that they may charge that are fixed. So obviously, if you have $12,000 worth of minimum fixed fees, and you put in $500,000, that's a big chunk of money out of the 500. But if you put in $2 million, and those were the same fees, it's just a smaller percentage. It's more efficient.
Okay.
But if somebody thought that the assets they were investing in were picked so well that they might explode in value and eradicate any drag on the money in the early years, that might be an analysis that needs to be done.
So this obviously we can see the value with this private placement life insurance contract in terms of its tax efficiency. Can you shed some light on what are the major considerations or potential risks that can be involved?
Sure. One, you always have investment risk. That's something that the insurance company or myself don't really get involved in. That's really for the client and the person who advises them as to what funds on the platform or what investments that are made by the policy. That's just like any other investment account. You want to make sure that the insurance company's fees are reasonable. To the extent that you can, you want to find insurance companies that will guarantee their fee structure, because if they're not, I guarantee you they're going to go up. Prudential, I know, has raised some of their fees over a number of times over a period of years on existing structures. On more of a custom-built model, where instead of picking managers on the insurance company's hedge fund list, you actually instead hire a manager to manage the assets. We call it a separate managed account model. So an RIA is actually acting as the manager. You have to be very careful. If the owner of the insurance policy, or I'll even make it broader than that, anybody who benefits from it, is helping determine what underlying investments are bought on a specific basis other than just a general basis, you will violate one of the two rules called investor control. And the IRS, if they see it, will absolutely categorically say that you own the assets, not the insurance contract, and therefore all of that taxable income you just thought you avoided, you will pay the piper. And there's a court case called Weber, where Jeffrey Weber had tens of thousands of emails directing his managers to what to specifically buy and sell, not just from a global perspective. And Jeffrey Weber in tax court found out that the court held that he was the tax beneficial owner of those assets, not the insurance company, and therefore he was responsible for all of the taxes that he thought he avoided. It's why the product is not a widely sold product because it's a hard product to scale for insurance companies because they don't really want to keep track of people violating investor control, so they would rather just limit you to the investments that are on the platform rather than have an individual manager managing the assets in a customized way.
Touching on that real quick, as you said, there's going to be shelf or platform investments they can go into, whether that's mutual funds or maybe some approved alternatives. Can you just real briefly touch on insurance dedicated funds, how what their applicability is in this world?
The first test that we talked about was the investor control doctrine. That is the owner, the contractor, the people involved getting too close to the specific buying and selling of assets. The second prong is called diversification. So that bucket that holds all those assets must meet a certain diversification test. No one asset could be more than 55% of the bucket. No two assets, 70%. No three assets together, 80, four assets, 90, and so on. In order to make this more scalable for the insurance companies, they created something called insurance dedicated funds. So if I went over to, I'll give you the example, if I went to a hedge fund called Millennium and had my policy invest into Millennium, or my separate managed account manager went to Millennium, even though Millennium has tens of thousands of underlying investments that are traded every day, because Millennium is not an insurance dedicated fund, it only counts as one asset, so I couldn't hold more than 55% of my investments in Millennium. Millennium has another structure called Millennium Estate Global. Millennium Estate Global is a hedge fund, and it's only available to insurance contracts or annuity contracts. It's an insurance dedicated fund. And because of that exclusive nature as to who can invest in it, it doesn't count as one asset. There's actually a look-through to see if the underlying portfolio is diversified. And if the answer is yes, that it meets that diversification test, then you can have 100% of your money into one insurance dedicated fund. So to say it a different way, when a manager builds a portfolio, you must meet diversification. Whether that manager is Millennium, or that manager is Bob Smith over at XYZ RIA, you must meet diversification. It's just much easier to click the box on funds that already meet the diversification testing. Most RIAs and investment management firms don't allow their investment advisors to be separate managed account managers because they have to certify at the end of every quarter that these policies did not violate the investor control rule and the assets meet the diversification testing. So compliance departments at big places are just like, there's just no way we want to add that layer of complexity to what we do. Just as an FYI, all of the mutual funds that are on an insurance company's platform for regular retail variable life are clone funds and are all insurance dedicated funds. So when you see I'll age myself, when you see the Fidelity Magellan Fund on Mass Mutual's variable life policy as an asset, that is not the same one you buy from your stockbroker. It is an insurance dedicated fund, and the only investors in that Magellan fund are insurance policies or annuities. It's a clone or a mirror or close to it of the original.
Well, I could listen to this all day. I mean, there's so much to cover with this topic.
Good, because my wife doesn't want to listen to it all day, so I'm glad somebody does.
There you go. Unfortunately, we are out of time. Ed, I want to thank you so much for coming on the podcast. It's been great listening and learning. There's such a wealth of knowledge in this space that you've given to us here. But so thank you very much. And I want to allow you, if you have any closing or final thoughts that you want to say before we wrap up.
We just want to thank you for the opportunity to speak and educate people more on a product that I think is underutilized in the marketplace for a lot of various reasons. But it's for wealthy individuals, it could be the centerpiece of a lot of their planning for various reasons.
Well, Ed, thanks again for coming on the podcast. It's been great. Eric, there's been a lot to digest here. Do you have any questions?
Absolutely. This was a ton of great information, the two of you going back and forth. I've learned a lot, but I also am completely overwhelmed with how much complexity there could be to these situations. I mean, that's what I'm hearing through this entire conversation. Ed, if somebody's interested in finding out more and they want to reach out to you, how do they reach you specifically?
They can reach me by just picking up the phone and calling us at our office, which is Preservation Capital Partners, 516-478-4221. The best compliment that we get from people is that we've made something very complex, very simple. So when we talk with clients, we kind of do it in a little different way. We use a term called Gerberize, which is making things into baby food.
Absolutely.
If somebody who makes widgets for a living and is successful tried to explain to me how they run their business, I'd probably not understand it at first. So one of the things that I try to do is break things down in a way that people can understand it and be able to regurgitate it back out.
Yeah. And the thing is, it's all individualized. That was something that you said and Chris has said. It's very much individualized for each person's situation. And speaking to that effect, Chris, I know that a lot of the current clients are listening to this podcast. And I know this podcast is going out nationwide. And there are people that are listening in and joining it every week. And they're brand new to this podcast. So if they would like to reach out to you to begin this conversation or even have you put them in contact with Ed because they have a relationship with you, what's the best way to get a hold of you, Chris?
Yeah, you could shoot me an email. It's easy. It's chyman@centurawealth.com. That's CHYMAN, Mary Andrew Nancy, in case I can't pronunciate today, at centurawealth.com. And my number here, direct line at the office is 858-283-0306.
Fantastic. Ed, thanks again for being on the show. And Chris, of course, thank you so much for bringing him on the show. But our last thank you is always reserved for you, the listening audience. Thank you so much for tuning in and listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks so much for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.